All right, everyone, welcome to beautiful Oslo. It's Michael here, and we are going to talk today about the wonderful subject of what it is like to be tax resident in Norway and what to do about it, what kind of structures and options there are available to you. So this is, one of the most affluent countries in the world. GDP per capita is like probably within the top 5 or so, and that goes in pros and cons, I guess. So if you were to compare it, it's a Scandinavian country. Scandinavian countries are typically high tax, good social programs, etc. Quality of life here is very good in a lot of respects. The advantage is because they have natural resources, taxes are a little lower than they are in places like Sweden or Denmark, so that's kind of nice. That being said, they're still pretty high, typically 38+% on the top end, and dividend income is taxed actually a little bit higher than it is in Sweden, interestingly. So that's something also to be aware of. Now, although it's got a bit of a progressive basis, so you could end up in a better situation. The name of the game here is the same as in Sweden, the same as in some of these Scandinavian countries, which is it's really highly tilted towards real business activity. So they've got a lot of rules or kind of nuances within their rules that are designed to go after people who have foreign businesses that they don't have real business activity, okay? So basically the way that it works is if you still have to deal with the management control rules, and in fact the management control rules are tougher than they are in Sweden. So basically, if you have a company that is formed abroad, but you're managing and controlling it from Norway, it's taxable in Norway. Likewise, if you are forming a company here, it's taxable in Norway. Their corporate tax rate is, again, 22%, so kind of that typical European level, which is not insane, but on the other hand, not great, especially when you add on to it the dividend tax portion of it. You end up at like 50+%, right? So not so great in that regard. Beyond that, so the key is, of course, if you want to optimize your tax here, what do you have to do? You have to form a foreign company. The question then is, where do you form it and how does that work? Well, first of all, you really have to be concerned here about management control. Like I said, more than in Sweden, more than in some of these places. So be aware, wherever it's managed and controlled, that's a big deal. You have to follow the appropriate rules. If you want to go into the rules on management control with us, please reach out to us, happy to discuss it with you. Next, of course, your income has to be sourced foreign, so you actually have to have operations there, same as in these other places. The bigger piece here, though, is they have a lot of rules specific to EEA entities. Okay, so if you're in the EEA, a lot of the rules that would normally cause problems for you, such as the CFC rules, don't apply. Here, the CFC rules are easier, basically based on 4 criteria. Okay, one is the company in the EEA? Number 2, is it a low tax country? Number 3, is it a country that they have a tax treaty with? And number 4 is, do you have real economic activity there? If you have real economic activity, you're good for the most part. Okay, so when we're designing a structure to optimize for people from Norway, what do we want? We want a country that's formed in the EEA, and this narrows you down pretty quickly, right? There's not a lot of highly tax optimized EEA countries. Combined with, we want real economic activity there. That kind of creates a bit of an issue because usually the economic activity is then going to be expensive, right? So let's take, for example, say we're talking about Gibraltar or Isle of Man or Jersey, Guernsey, something like that, which would be the ideal. Well, it's expensive there. You have lack of access to talent, etc. You could go with something like Bulgaria, where taxes are lower, cost of wages are lower, etc. Hungary, similar sort of deal. So those are some options. Cyprus potentially becomes an option. Malta becomes an option. Estonia, Latvia, things like this. The other way to go is to say, okay, well, you're not going to do an EEA country. Tougher because some of the rules are going to not work with your favor. And so then what's the consequence? Well, then the deal is, it still has to work for the CFC rules, etc. It's going to be tougher, but it'll open up a few more options to you, right? So something to look at. Again, being aware that you could get away with something simple like Bulgaria is kind of nice for people from Norway, because you're basically reducing your corporate tax rate by more than half, right, from about 22% to 10%. So this brings up the question of, what about participation exemptions? So if you have a Norwegian company which owns a foreign company, then under a bunch of circumstances, you can bring the dividends back and you are 97% tax exempt. So that's not so bad, right? It means you have 3% of the income, in this case would be dividends, would be subject to normal corporate tax. That's not too bad. It's pretty close to 100% exempt. And then you could receive accordingly. So for somebody who wanted to structure it in an appropriate way, you might say, okay, maybe what your structure would look like is you would own a Norwegian company, you would have a foreign company, there would be staff outside of there, it would be foreign managed and controlled, etc. Say in some place like Bulgaria, you would take advantage of the EU parent subsidiary directive when you pay out dividends from the Bulgarian company to the Norwegian company. You could then show, for the purposes of loans, etc., the income in Norway, and you would pay, in the portion that you take, you would pay dividend tax on. You could perhaps do that with respect to taking advantage of some corporate write-offs, but it's not quite ideal. So what are some better options? You could use a trust structure. Trust structure is always something that we want to look at in these particular situations. It's going to allow you to get around some of the rules that would normally be an issue. Another thing that you might be able to do is you might be able to say, okay, well, maybe you have the type of business that you can have real economic activity in some place like Georgia, Gibraltar, Isle of Man, Jersey, Cyprus might be an option. Malta's a little bit weird because of how they do their system, and so whether it works out better or worse, that's questionable. But, all options. Normally, I would say that Bulgaria and Cyprus are your typical best options if you're going to have real economic activity. The other thing that you could do is you could have real economic activity there to the extent that you have management, to the extent that you have maybe some marketing activities, some core business functions, but then you could outsource some other functions outside of that country to a lower place where you have better access to talent and you have lower wages. So all these can be played around with. The important thing is just to recognize that in Norway, more than most places, EEA countries are definitely favored, and real economic activity is an absolute must. So if it makes sense for you to form a company, build a real business there, then by all means, check it out. If you want some help with it, reach out to us, and we're happy to help you. We'll leave it at that for this video, and we will talk to you guys on a future video.